Welcome to The Deep Dive, where we cut through the noise to get to the core of what truly matters to you. Today, we're unraveling the latest earnings from the Toro company. You might know them from your own yard, maybe, but their financial story, well, it's got some layers. We've sifted through the reports, the calls, and we're ready to show you what's really driving this company.
Yeah, our mission today is really to distill those critical takeaways, take all that dense financial stuff and, make it clear. We'll look at the surprising strength in some parts of Toro and the real challenges in others, give you the full picture.
All right, let's jump straight in. The headline numbers, because Toro's Q3 fiscal 25 results, well, they were a bit of a head-scratcher at first glance. They delivered an adjusted EPS of $1.24. That actually nudged past analyst expectations by 2 cents. So a small beat, but still a beat.
Precisely, a beat's a beat. But the top-line revenue, that told a different story. Total net sales came in at $1.13 billion. That missed expectations, and it was down 2% year over year. It's worth noting, though, about half of that dip came from strategic divestitures they did last year, selling off some businesses.
Right, those divestitures. So earnings beat, revenue miss, planned or not, it's mixed. And here's where it gets really interesting for me. We saw that initial share price dip right after the release, didn't we? But then it mostly recovered by the end of the day. That's a fascinating reaction from the market. What's your immediate read on that bounce back?
Well, what's truly fascinating, I think, is that recovery, it tells us investors aren't just looking backwards. They're basically saying, okay, residential is weak, we see that, but the professional segment, that's a rock. It's like the market sees it almost as two different companies, and they're really betting on that industrial grade engine,
That divergence, that seems to be the absolute core of the story here. Let's unpack those segments, because it really shows how effectively Toro has diversified its business, I suppose.
Absolutely. The professional segment was, it was a powerhouse this quarter, no question. Net sales there didn't just creep up. They soared to $930.8 million. That's a robust 5.7% year-over-year increase. And here's the kicker. Its earnings margin expanded by 250 basis points, that's 2.5 percentage points, up to 21.3%, really driven by strong demand in underground construction, golf, and grounds, plus good pricing, productivity gains, just firing on all cylinders.
Okay, so professionals really humming along. Great growth, great margins. But then there's the residential segment. That seems to be the complete flip side of the coin, doesn't it? The part really feeling the pinch.
Oh, absolutely. Stark contrast. Residential faced significant headwinds. You could really see the economic uncertainty hitting there. Net sales just plummeted, down 27.9% year over year to $192.8 million. And the earnings margin crushed, down 1,030 basis points. That's over 10 percentage points to just 1.9%. Really thin. Management basically said homeowners are delaying those big ticket purchases, holding off. And the channel partners, the dealers, they're being cautious with inventory too. Makes sense.
And that big non-cash charge we saw, the one tied to Spartan, that hit the GAAP number pretty hard. Does that signal management thinking this residential slowdown might last a while?
That's a sharp observation. Yeah, the non-cash impairment charge, 0.6 Kluber per share, $81 million pre-tax, tied to the Spartan trade name. Basically an accounting move, writing down the value because they don't expect it to generate as much going forward. No cash actually changes hands, but it definitely impacts the reported profit. And I think it highlights those challenges in the consumer business. It does suggest maybe a bit of debt glaring, anticipating this weakness might stick around.
Okay, so looking at the whole company's profitability.
Yeah.
The adjusted operating margin. How did that hold up with these really opposing forces?
Well, it showed some resilience, but couldn't completely offset the residential drag. The overall adjusted operating margin was 13.6%. That's a slight dip from 13.7% last year, mainly because of those lower residential sales. But the adjusted gross margin was actually okay at 34.4%, shows some core cost strength. And free cash flow, that was actually quite strong, $292 million through Q3. Good conversion rate, 90%, driven by better working capital. Plus, they bought back $90 million in shares in the quarter. $290 million year to date. That's usually a sign of confidence.
Right, so they're not just reacting, they're being proactive.
Yeah.
What about those bigger strategic plays, the things management highlighted to, navigate these choppy waters?
Yeah, a major theme absolutely was the ongoing AMP productivity program. Think of it like a big internal efficiency drive, streamlining everything. And it's working. They've already delivered $75 million in annualized run rate cost savings so far, and they're on track for at least $100 million by 2027. What caught my ear was management hinting at AMP 2.0 or AMP squared coming in Q4 suggests they might even raise those savings targets. That's huge for future margins.
A&P squared. Huh. Okay. And they also kept talking about portfolio changes. That seems like a constant theme for Toro, this pruning to grow idea.
Exactly. They're actively managing the portfolio. Earlier in August, they sold off the Trencor brand and the auger boring part of American Augers. The idea is to really focus their underground construction efforts on higher growth stuff like horizontal directional drilling, HDD. This follows selling off some dealers and other products earlier. It's disciplined, shedding lower growth things to focus capital where it counts more.
Makes sense. And tariffs. Everyone's watching those. How are they handling that?
Good question. They gave an update. Initially, they thought the extra tariff hit for FY25 would be around $65 million. Now they've revised that down to about $45 million, so better than expected. And they're actively working on mitigation, aiming to be margin neutral by year end, using productivity gains, especially in golf, and some pricing tweaks. They also confirmed their stuff made in Mexico meets the USMCA rules, so that limits exposure there. Pretty proactive, I'd say.
Okay. Any big leadership moves or interesting new products that jumped out at you, signs of future direction?
Yes, actually. A key appointment right around the call. Edric C. He's a 29-year Toro veteran. He's now President and Chief Operating Officer effective September 1st, responsible for all global businesses, supply chain, signals a real focus on execution. And on the innovation side, yeah, some cool stuff. The Ventra 45 RC, that's a remote-controlled mower. Electric material handlers like the Attract Engingo and Ultra Buggy leaning into electrification. New directional drills for the pro side. And even the GeoLink MO autonomous fairway mower, a robot for the golf course, shows they're pushing innovation.
The robot mower. Okay. So putting all these pieces together, strong pro, weak resi, the A&P savings, divestitures, tariffs, new leadership. What's the actual outlook for the rest of fiscal 25 and beyond?
Well, the official FY25 outlook is definitely cautious. Can't blame them, given the mixed. Total net sales are now expected to be flat to down 3%. So towards the lower end of their old range, adjusted EPS projected around $4.15, also at the lower end of prior guidance. But professional segment revenue is still expected to be slightly up. That's key. While residential, yeah, that's expected down mid-teens.
Mid-teens down for resi. Ouch. Are there any green shoots there? Anything positive looking ahead for that side of the business?
There are some encouraging signs, yes. Management said they've made significant progress cutting down those residential inventories out in the field at the dealers. That should mean a cleaner start for the 2026 spring selling season, less old stock hanging around. For their own inventory, Toro's aiming for over 3 turns a year as a first step, better efficiency, and the professional segment. Comfortably expected to grow again in FY26, plus more potential margin upside there from cost cuts and pricing. They also mentioned, if interest rates start coming down, that could really trigger a better consumer response for those big ticket items.
Yeah.
That's the macro watch point.
Right, the rate cuts. Okay, so back to the market reaction. That initial dip, then the recovery. You said investors are weighing resi weakness against pro strength. But is there a risk that if resi stays weak for too long, it starts to drag down overall confidence, even with the pro side doing well?
That's the critical question, isn't it? For now, the market seems confident. But yeah, continued resi woes could eventually become a drag. What gives the professional segment such a strong anchor, though, are those underlying secular trends. Things like record golf participation, multi-year infrastructure spending. These aren't just short-term things, they're long-term drivers. That gives investors a solid foundation to believe in, even when the consumer side looks soft. It's just a very different demand cycle.
And those strategic moves, the divestitures, the pruning to grow, that seems to be landing well with investors too, signaling discipline.
Precisely. Selling off Trencor, the auger boring stuff, It shows they're serious about focusing capital on the best opportunities, high growth, high profit areas. That kind of disciplined portfolio management, it's exactly what long-term investors like to see. Smart capital allocation.
And the cost savings, the A&P program. Are those just temporary fixes, plugging holes, or are they really changing the underlying efficiency of the company?
Oh, I think they're more than just plugging holes. They feel foundational. A&P plus the tariff work. It's about protecting earnings power, whatever the market throws at them, getting to margin neutral on tariffs, hitting those big A&P savings targets. It shows strong operational control. It de-risks the investment case, building a leaner machine.
And clearing out that residential inventory. How big a deal is that really? Just housekeeping or more strategic?
I'd say it's more than just housekeeping. It's strategically important. That meaningful reduction in channel inventory, it removes a big overhang. Dealers aren't stuck with old stuff. It sets up a much healthier potential start for FY26. It doesn't fix demand overnight, obviously, but it clears the way for a cleaner rebound when sentiment does turn.
All right, okay. It's time for our favorite part. Let's head over to the investment committee. How could these dynamics play out in the market? What's the outrageous but plausible trade idea?
Okay, let's think about this push and pull. Consider a potentially asymmetric play here. My thesis is basically this. The market might be undervaluing the long-term margin upside from that strong professional segment and the AMP savings, especially when you contrast it with the cyclical residential business, even if it recovers. So I'm thinking about a long strangle on TTC. Target the March 2026 expiry. Give it some time to play out. Now, for those maybe less familiar, a long strangle means you buy both an out-of-the-money call option and an out-of-the-money put option. You're betting on a big move, up or down, so maybe buy the $95 strike call banking on a big jump up, and simultaneously buy, say, the $70 strike put protecting against or profiting from a big drop.
Long strangle.
Okay.
Betting on volatility. So you win if it moves significantly either way,
Yeah.
but the risk is if it just stays flat.
Exactly. If the stock just trades sideways between $70 and $95, both options could expire worthless and you lose the premium you paid. That's the risk. But here's the upside rationale. If Crow keeps rocking, if AMP 2.0 really delivers more savings, and if resi demand just modestly normalizes by spring 26, then that $4.15 EPS guide for FY25 could look really conservative for FY26. You could easily see a 10-20% pop in the stock as the market re-rates. Your $95 call pays off nicely. Now, the downside case. What if tariffs get worse despite their efforts? What if infrastructure spending slows down? Or what if residential stays absolutely stuck in the mud well into 2025? Sentiment could really sour. That Spartan impairment shows there's vulnerability, maybe more write-downs. The market could derate the stock significantly. Your $70 put option comes into play.
So it's a play on potential surprises, leveraging either better than expected strength or worse than expected weakness.
Yeah.
And the long expiry lets that story unfold.
Precisely. It bypasses the immediate post-earnings noise and gives the bigger trends, the segment divergence, the AMP impact, time to really move the needle significantly one way or the other.
Okay, so wrapping it up. The Toro Company's Q3 FY25, a mixed bag, definitely. An adjusted EPS beat, yes, but that revenue miss driven mostly by residential weakness.
Yeah, the professional segment is clearly the engine here. Strong growth, good profits, helped by those divestitures and the AMP cost controls. The FY25 outlook is cautious, no doubt. But those underlying operational gains and the long-term trends in pro markets, they suggest a pretty resilient core business with clear potential upside.
So as Toro navigates these different currents, the real question for you, the informed observer, is this. Is this residential weakness just a temporary blip, offering a chance to get into a strong, pro-driven company? Or is it a sign of deeper challenges ahead? Definitely something to mull over as we watch for those green shoots heading into 2026.
And please remember, everyone, the information presented here is just for informational purposes. It is definitely not financial advice. Thanks for diving deep with us today.